Started with the credit idea. Has anybody in this room ever borrowed money or lent somebody else money? Raise your hand if you've done that. Most people have done that, right? At some point or another, we have either borrowed money or we have lent money to someone we know, right? So, how did that loan involve? What did that loan involve? Like, obviously, most of the time, if we loan them something, it can be money, tools, maybe a car, things of that nature, right? If you let someone borrow money, how do they plan on repaying you? Do you guys remember?
When they get it.
When they get it, did you charge them interest or anything like that? No, most time if you let somebody borrow $20, if they give you $20 back, everything's good, right? Now, when it comes to banks and things like that, credit cards, if they let you borrow $20, what are they wanting in return?
Interest.
They're going to try to make you pay interest. Does that make sense? So, today we're basically going to talk about the basics of loans, okay? So there's a little YouTube video that I want to show you. It's about 4 minutes long. That kind of give you an idea of what we're talking about, okay? So pay attention to this real fast.
Finally some alone time.
Did somebody say long time?
No, nobody said alone time. I said alone time.
Right on. Time for a loan.
No, I want to be left alone.
Clearly you're confused about how loans work. I was once that way too, little dudette. But don't worry, I can tell you all about it.
Great.
Loans are like surfboards because there are different kinds to suit your individual needs. Student loans for tuition, mortgages for buying property, auto loans for getting a vehicle, small business loans for entrepreneurs, and payday loans. Although, to be honest, I'm not too stoked on those. They're kind of the worst.
So loans are tailored to the stuff that most people can't pay for up front.
Totally. A typical loan looks like this. There's the principal. That's the amount you're borrowing. Then there's the interest rate. That's a percentage that your financial institution charges you for lending you the money. Then there's the term. That's the amount of time you have to pay it all back.
That makes sense so far.
Righteous. Loans can either be secured or unsecured, depending on whether or not they're protected by collateral. Collateral is something valuable that the lender can take as repayment if you default on your loan and can't pay it back. It's usually something big, like your house or a vehicle.
That sounds scary. Why even bother with a secured loan?
Because secured loans usually have lower interest rates since they're less risky to the lender than an unsecured loan. Don't worry, little dudette. They're only scary if you can't afford your loan.
Are there other ways to lower the interest rate?
Interest rates are like ocean tides. They're influenced by a ton of different factors, and nobody knows how they actually work. Every lender is going to use a different set of factors to see whether or not you're eligible for a loan and what your interest rate will be. Factors like your credit score. Higher credit scores qualify you for lower rates, so it's worth it to get your score in shape before applying for a loan. The loan itself. The more you borrow and the longer the term, the higher the interest rate will be. Then there's your life situation. Lenders look for things that suggest you'll be able to pay back your loan. A good employment history helps. Not having any other debts help. Even having a long-standing relationship with a financial institution can help.
What about getting a cosigner?
Totally excellent question, surfer girl. A cosigner is like a surfing buddy. If you wipe out on your loan, he or she is the one responsible for its repayment. But being a cosigner is as risky as hanging 10 in a hurricane because your credit history can be affected by the loan as if it were your own.
So it needs to be someone who trusts you a lot.
Totally. I have one more surf tip for you, and that's to see whether or not your loan has a variable or fixed rate. Fixed rates stay the same throughout the entire term of your loan, whereas variable rates are based on a chosen index. If that index goes up, so does your rate. If it goes down, so does your rate. Fixed rates are nice, constant, and easy to plan for in your budget. But the interest on those is usually a little higher because the lender has to anticipate that the rates may rise in the future.
Like that giant wave over there?
Oh, surf's up! Later, dudette!
Alright, so in that, they brought up a lot of points that I need you guys to understand, okay? So what I'm going to do is basically we're going to take these notes together. I've kind of laid them out for you of what we're going to try to do today. So at the top of your paper there, jot down that this is the introduction to credit, okay? So we're basically going to go through what he just explained to us in that little video, but we're going to try to make it simpler. So there's, just like the financial services, there's a lot of definitions to that, right? So there's going to be quite a few definitions when we're talking about credit and loans too. So at the top is the question that I asked you earlier. So have you ever borrowed money from or lent money to someone? You guys know the answer to that. You know what kind of idea you came up with for getting paid back and things of that nature. But we're going to start with just loan basics here, okay? So there's three definitions. I put a star beside all three of them. We need to know what each of these are, okay? So the first thing is the word principal. The word principal, when it comes to a loan, is if I go into a bank, a credit union, savings and loan, an insurance company, a payday cash store, a check cashing store, whatever I go into as far as financial institutions, if I need to borrow $10,000, that is my principal loan. That is the amount of money that I am borrowing. Does that make sense? So, beside of principal, simply put down that it is the amount of money that is borrowed. Okay? So the principal is the amount of money that we are going to borrow. Is everybody with me there? So far, so simple. So if I need to go borrow money for a car and that car is $8,000, if I go borrow $8,000, that is my principal loan. That is the amount of money that is borrowed. All right? So far, so simple. The next word we got here is the word interest. Now, we've talked about interest mostly throughout this semester. If you have to pay interest, is that good or bad?
Bad.
Yeah, nobody really wants to pay interest, do they? Because that's money that you got to give back. You're paying somebody for letting you borrow something. Okay? Now, if you're receiving interest, that's a good thing, like on a savings account or something of that nature. But interest, guys, is the percentage, and I just draw a little percentage sign. It's the percentage, which is usually yearly. We can put annually, because annually means yearly. So it's the percentage, usually annually, being charged for the right to borrow money. I didn't leave myself enough room. For the right to borrow money. Okay? So that annual percentage or interest rate that we are getting charged, that's the amount of money that our lender is going to make. Does that make sense? So if I go borrow $10,000, y'all with me? And they charge me 3% interest. That's basically 3 cents per dollar that I borrow. Does that make sense? So if you do the math on that, and I'll just do it on my phone really quickly. If I borrow 10,000 and I multiply that by 0.03, my interest on that is about $300 over the course of the loan. Y'all with me? So that $300 is what whoever I borrowed the money from is making. So that's an interest rate. So far, so simple. Now that's just basic. It can get really complicated, but interest, we want to, when we borrow money, do we want a high or low interest? We want it as low as we can possibly get. Okay? And then the last term, as far as the loan basics, is the word term. Okay? And your term is the amount of time it takes to pay back your loan and interest. Now, will most banks or credit companies give you a certain amount of time? Like when you go buy a car, is the guy that sold you the car going to say, "Oh, just give me that money whenever you get time"? No, what are they going to do?
Give you a certain amount of time.
Yeah, they're going to give you 4 years, 5 years, 3 years. You know, you can negotiate how long of a term. Now, understand this. The shorter the term, is my payments going to be higher or lower?
Higher.
They're going to be higher. But my interest will be lower, right? Because it's taking me a shorter amount of time to pay it off. Now, if I stretch it out over a long period of time, what's my interest doing? It's going to be higher because I'm paying longer on it. So the term is the amount of time it takes to pay back a loan and interest. Simple enough? Okay? Now, moving on down with this, again, we're just basically going off the video here, just to give you guys an idea how this works. Obviously, these three are very important ideas. Okay? We're going to talk about a secured and unsecured loan and the advantages and disadvantages of both. Okay? So, the first one, what are the advantages of a secured and an unsecured loan? So, with a secured loan, we're kind of going to list these. Okay? Now, what do they mean by secured? If it's secured, that usually means that there has that collateral has been offered. Now, I know in the little video it told you collateral was something that you put up against the loan. Like, for example, if I want to go borrow $5,000 and the company that I'm borrowing $5,000 from says, "Well, do you have any collateral?" I could put my car up against it. Meaning, if I don't pay that $5,000 back, what does that company
lose your
get?
car.
They get my vehicle. So that's collateral, right? Now, obviously, guys, you're only going to use collateral if you're 100% sure that you can pay that loan back, right? You're not going to put your car up against something or your house up against something knowing that you can't pay it back. So if I'm lending you that money and you're telling me you're going to put your car up against it, the interest is probably going to be higher or lower? Lower. You're putting your car up against it. So I'm pretty confident you're going to pay this loan back, right? So I'll give you a lower interest rate on that. Okay? So, beside a secure loan, the first thing I would like for you to write down is that it requires collateral. Is everybody good on what collateral means? It's something you put up in case you can't pay the loan back. So it requires collateral. Obviously, which can be taken if loan isn't paid. Okay? So it requires collateral. Now I'm going to jump down before we finish this. You guys see where it says examples of collateral? Y'all don't have to write this part down yet because you're probably not there in your notes. But I'm going to go ahead and jot down a few ideas. Examples of collateral, I already told you one. Your car, right? Your automobile. What else can you be used as collateral? Your house. Could I use my farm if I needed to?
Yeah.
Yeah.
Basically, anything.
Could I use property if I needed to? Yeah, I could. Yeah, you're right, Jace. I can basically use whatever I want to as long as the lender approves it. Does that make sense? But again, a secure loan requires collateral. So since it requires collateral, guys, the second concept to a secure loan, put down that it is safer for the lender. So if I go into a bank and want to borrow $100,000 and I put my house up against it, then the bank's going to feel pretty confident that I'm going to pay them back, right? Because if I don't, I'm going to be homeless. So I have an incentive to make sure I make that payment, right?
What if your house ain't worth that much?
That's a good question. You can only borrow up to how much you have collateral in. So if my house is worth $50,000, they will let me borrow close to $50,000, not over it. Does that make sense? So a secure loan is safer for the lender, okay? And then the third thing, you guys have already answered this. Will I get a lower or higher interest rate if I put collateral up? I'll get a lower interest rate. Because again, it's safer. The lender feels comfortable allowing me to have that money because I'm putting something up against it. Does that make sense?
Does banks do that?
Oh yeah. Oh yeah. Credit unions, all those financial institutions that we talked about. I'm sorry?
Who does the unsecured one?
The bank will do that too, but there's stipulations to it that's different than a secured one. Okay? Like every loan I've ever had's been unsecured. I've never put anything up for nothing. You know what I mean? So, is everybody good with a secure loan? Does that make sense? Okay. Let's talk a little bit about the second one here, an unsecured loan. And it's basically the opposite of a secured one. So if a secured one requires collateral, is an unsecured loan going to require collateral? No. So it does not require collateral. So I don't have to put anything up against this loan. They are, the bank has looked at my credit history, and this again, it's why you want to have good credit. Y'all got me? Remember me drawing you the little credit score line? You want to have good credit. If you buy something and have to make payments, make those payments on time. Build your credit score up. Because if you build it up, you can get unsecured loans easier. Okay? So, it does not require collateral. So, since it doesn't require collateral, is it safer or more risky for the lender to allow you to have the money? It's more risky for them because the bank's giving you that money and they are hoping you pay them back. They've checked your credit score. You seem like the type of person that would pay a loan back, so here you go. You know what I'm saying? So they're taking a chance. So put down that it is more risky for a lender. And again, these lenders are all these financial institutions that we talked about earlier. Okay? So it's more risky for a lender. And then common sense, guys, what do you think you're going to get for an interest rate if there's no collateral? A higher or lower interest rate?
Higher.
It's going to be a higher interest rate. The lender wants to make money somehow, right? You've not put any collateral up, so he's going to figure out how to make money, or the institution is going to figure out how to make money. So higher interest rates. Okay? So basically, guys, if you can just remember what one of these are, the other one is opposite, right? So if you can just get in your brain what a secured loan is or an unsecured loan, you know that the other one is opposite. Okay? We've already wrote down the examples of collateral. Guys, we could write down 25 different types of collateral. Whatever it is, it has to value the amount of the loan. Okay? Pretty simple. All right? And then lastly here, I've got down factors that determine an interest rate. So, factors that determine an interest rate. So basically, how are they going to know? Like if me and Jace go into a bank today, who's probably going to get a lower interest rate, me or him? Me. And it's not because Jace don't have as much. He's never borrowed money. He's probably never paid back any money. The bank has no credit score for Jace. You guys understand that? They have a credit score for me. Hopefully they think it's pretty good and I get a low interest rate because I've done good with my credit score. People with bad credit scores, they tend to have issues with it, right? So, factors that determine interest rate that will be charged for money borrowed. The first one I want you to write down is a credit score. These are so important, guys, later in life. Is a credit score, okay? And it's just like anything, the higher it is, the better off you are, okay? So, the higher score equals lower interest. I know y'all can't see that because of my left hand being in the way. But a credit score...
That's what Amy was talking about last night.
Huh?
That's what Amy Joe was talking about last night.
Can't see nothing because of my hand. Yeah. Credit score is... The higher the credit score, the lower your interest. So you want your credit score to be through the roof. Okay? That way you don't have to pay so much interest on anything. Everybody with me there? Makes sense? All right, the next thing that will determine the interest is the type of loan you get. Okay? The type of loan you get. And what I mean by that is this. The more money you borrow, guys, the longer you're going to be making payments. Does that make sense? Which it should. If I borrow $1 million, it's going to take me longer to pay that off than what it'd be to pay off 10 grand, right? So, the higher the principal, so the higher the amount of money that we borrow, higher the principal. Equals a longer term, which means I have to pay it off longer. Y'all with me? Which gives us a higher interest rate. And the reason the interest rate is higher is because it's taking me so long to pay it off. Does that make sense? So, if I have a low principal, I'm going to have a shorter term with a lower interest rate, right? But a loan depends on the loan. Higher interest, longer term, higher interest. Y'all with me? Excuse me, higher principal, longer term, higher interest. So the more money I borrow, the more time it's going to take me to pay it off. I'm going to pay more interest in that scenario. Does that make sense? And then lastly here, as far as today goes, and we'll pick it back up on this tomorrow, the last thing that determines your interest rate is your life situation. Okay? Is your life situation. Things like your employment history. Guys, if you've worked one job for 40 years, then obviously it's pretty stable that you're going to have good employment. Probably a really good credit score, right? Because you've had the same job for the same amount of time, for a long period of time. Now, if you're jumping back and forth between jobs left and right, that doesn't necessarily mean you have bad credit. It just shows you're not really stable. Does that make sense? He jumps around a lot. Is he going to do that with this loan? You know what I mean? The loan itself, okay? The loan itself. And what that means is, are you going to be able to pay it back? What kind of term are you getting? You know, all this revolves around the credit score, okay? And then the last thing it kind of looks at is your total debt. Okay, if I already owe $500,000, you think a bank's going to allow me to borrow another $100,000? No, they're going to see if I've been paying that back. So the lower the debt you have, the more likely you'll be able to pay that bill. Does everybody understand that? So that's kind of where we're at today. All right, tomorrow we're going to talk about the cosigners and things of that nature. We'll talk about the variable and fixed loan stuff, and then we're going to categorize credit, okay? So does anybody have any questions about the first steps here? All right, remember, the ones of you that haven't turned in your financial services quiz, it is due tonight at midnight, so make sure you get that in, okay? And then, again, tomorrow we'll continue this credit stuff. All right? Is everybody good? Any questions? All righty. That's all we got for today.